Good evening, everyone. I hope you're doing good. Well, good, guys. Last session from my end in this FM series of online lectures. Topic for today is leverages. Okay. For that, let me see if there are any queries or any issues. Mansha is asking, can PAT be more than EBITDA for capital right businesses that are cash rich and debt free companies? This is possible. Is it right? PAT be uh, more than EBITDA? It cannot be. PAT cannot be more than EBITDA because you derive PAT after deducting depreciation and amortization. So definitely PAT is going to be lower than the entity, lower than the EBITDA. Shreya is asking, good evening, sir. In case of approach without tax, why we take debt equity for calculation of KE of leverage company? In case of with tax, we take the ratio as debt upon debt plus equity. Shreya, in case of approach without tax, uh, the value of both the firms remains same, and we obtain KE by the backward calculation. First obtain KO because KO is supposed to be same for both of them, and then we do the backward calculation, obtain KE. Okay. EBITDA, Mansha is asking, EBITDA is based on accrual concept of operating profits. If company has interest income, non-core activity, and debt is zero because the company is cash rich, then it can be possible that EBITDA is lower than PBT or PAT. No, Mansha, because you obtain EBITDA by adding back the depreciation and amortization to earnings before interest and tax. Your EBITDA is definitely going to be a greater number. And if the company has interest income, non-core activity, yeah, if you take EBIT as a operating figure, only operating EBIT, then that's possible. Because you consider interest income to be your non-core activity, then it's possible. Otherwise, in general sense, it can't be the case. Okay. Now, let's begin with the chapter of leverages, guys. Um, Coming to this chapter, it's a simple chapter in which this word leverages has been derived from the word lever. It has been derived from the word lever in physics. You remember this word lever in physics? Physics, you might have learned this word lever. To showcase you some examples of lever, some examples of maybe leverages. You can say leverage was one sort of thing, in which there used to be a plank like this, or there used to be a rod like this. There used to be a fulcrum over there, and we used to have a load over here. And in between, this used to be said as a fulcrum, and here the force was applied. Right? To just imagine this sort of seesaw. It's seesaw puzzle. There used to be one person on this side, the other person on the other side, right? Or you can imagine this particular arrangement as a huge rock lying on the side of the road, and the workers are trying to push that rock to the other side, or they're just trying to shift it somewhere else. So in that case, they use this sort of rod. They place some load over there, and they push it on they apply pressure on the other side, and then the load gets shifted. Another example of leverage could be a bottle opener, right? Could be a bottle opener. I know the drawings are quite awful, but then I hope you're able to visualize what I'm talking of, right? So we're talking of a typical bottle opener. Again, there used to be a load over there with some fulcrum efforts over there. Right? So these were some types of levers that we had. Type 1, type 2 lever. Now, the word leverage has been derived from this concept. Now, what is happening in this typical thing? What is happening in this typical mechanism? Uh, load over here, load over here simply was the effort, was the result that we were targeting it. So, in this, they are in this, both the examples, what is happening is I cannot lift this load with my bare hands, because doing that with bare hands is really difficult. You cannot push it with your hands to the other side of the road. Similarly, you cannot open this bottle, you cannot open the cap of the Coke bottle with your bare hands, with your fingers. You use this apparatus, you use this tool for obtaining the objective. And the basic thing that both of these were doing, both these activities, or I can say both these instruments were material in actually helping you out to perform a difficult task with ease. I can say lever is used to perform, lever is used to perform difficult tasks with ease. Okay, so because these activities you cannot do it with your bare hands. You need to perform something else, or you need to use these tools to get the results. So lever is basically used to perform the difficult task with great ease, and moreover, we can say, so this is a case where you obtain great results with less efforts. The lever is where we obtain great results with less efforts. So we obtain these difficult results with lesser efforts, right? Now, something of this sort actually happens in finance world also. Something of this sort happens in the finance world also, wherein you put very much less effort, but you are able to realize great results out of it. You put a lesser amount of effort and you are able to get great results out of it. Now let's try to understand how does this happen in finance world with an example. Let's say we're talking of a company uh, which sells certain products at a selling price of 10, variable cost of 4. And when I'm selling 10,000 units, of course, the sale is going to be 1 lakh. Variable cost, we can say, since it is 4 rupee per unit, that's going to be 4 into 10,000, which is 40,000. Contribution comes out to be 60,000. Right? And let's say if the fixed cost, we're having a fixed cost of 25,000. A fixed cost of 25,000 will make the EBIT 35,000. Interest is 15,000, and what you get is profit before tax of 20,000. Right? So I'm assuming these figures are assumed. Okay, yeah, the fixed cost and the interest figures are assumed. So if we take tax rate of 30%, that translates to 6,000 as the tax. Profit after tax is 14,000. And then the number of equity shares is, let's say, 1,000. And we say EPS stands as 14 rupees. Right? This is the typical income statement that we have. The typical income statement that we have for 10,000 units. Right? Now, we are going to see what is going to happen. What is going to happen when the number of units are going to change. Okay. number of units are going to change. So suppose the number of units increase by 10%. Suppose the number of units increase by 10%. So of course the units will become 11,000 now. Units will become 11,000, right? I think if the units increase by 10%, units will become 11,000 units. And now at this 11,000 units, let's look at what is the EPS. Okay, so sales of 1 lakh will become 1 lakh 10,000. Variable cost, since variable cost is 4 rupee per unit, so 4 into 11,000 is 44,000. Then contribution stands as 66,000. Is the fixed cost going to change because there's a change in the sales value or sales level? Tell me, guys. Is the fixed cost going to change? Is the fixed cost going to change? Of course not, because it's a fixed cost. As the name says, the cost is going to remain fixed. So that's going to be 25,000 itself, right? And then what we have as the EBIT is 41,000. Interest of 15,000. Right, so 41 minus 15,000 will make it as 26,000. Now the tax will be, of course, the interest is also going to remain constant and fixed cost is also remaining constant. Tax would be obviously at the rate of percent, so the tax amount will become 7,800, and the PAT is 18,000. That is 18,200. Number of equity shares remaining same as 1,000 will make the EPS as 18.2. Right? Then if I look into the other angle, now considering only this plus 10% criteria, right? If you look at the way in which the percentages are changing, when the units have changed by 10%, what has happened to the contribution? The contribution also has changed by how much? Rupees 6,000. You can say contribution has increased by rupees 6,000, which translates to how much percentage change. What is the percentage change in contribution over here? So percentage change is same 10%, or you can say 6,000 divided by 60,000. Right? Then look at this change in EBIT. So EBIT has also changed by 6,000, but is the percentage same? Earlier my EBIT was 35,000. It has become 41,000. So by what percentage has it changed? It has changed by 6,000 divided by 35,000. It has changed by rupees 6,000 divided by 35,000. That will become 17.14%. That will become 17.14%. Then if you look at the change in PBT, the PBT has also changed by 6,000. But now, what is the percentage change in PBT? PBT has also changed by 6,000. But when I talk of percentage change in PBT, you will say, so 6,000 divided by 20,000, that is a 30% change, right? And you will find that talk of PAT, talk of EPS, this has the PAT has actually increased by 4,200, which is nothing but plus 30% of original value. EPS has increased by rupees 4.2. EPS has actually increased by rupees 4.2, which is nothing but again plus 30%. Okay, nothing but plus 30%. Now, what is my point of contention over here? What do I want to really talk of over here? I want you to look at typical numbers, three typical numbers, or I can say three typical areas. One is the percentage change in look at the percentage change in units over here, this figure, then this, this one, and then this one. If you look at these numbers, contribution, or again say when there is a 10% change in sales, the difference in percentage comes at this stage, which is the EBIT. And then you have a 30% change in PAT. Okay. So this concept is what exactly mean by the leverage. Now, what do you mean leverage over here? See, 10% extra efforts you put in. You put up extra 10% efforts on sales. You have put up extra 10% efforts on sales. That leads to 17.14% extra result in EBIT. You put up extra 10% efforts in sales. What you get in return at EBIT level is additional 17.14%. Okay. Sir, if I put extra 17.14% efforts in EBIT, my EBIT increased by 17.14%. All my subsequent numbers didn't change by same percentage. In fact, they changed by a higher percentage of 30%. Right? So, when we talk of leverage, here we talk of three types of leverages. One is a operating leverage, financial leverage, and combined leverage. Operating leverage, we say operating leverage. What does it simply mean? Operating leverage means, guys, over here we say operating leverage means the efforts that you put in is sales and the results that you get is EBIT. So operating leverage tells you by what percentage will EBIT change for 1% change in sales. So if you change your sales by just 1%, by what percentage is your EBIT going to change? Okay, so here we say efforts are sales and results are EBIT. So if I talk of this typical example, for 10% change in sales, we observe 17.14% change in the EBIT. For a 10% change in sales, we observe 17.14% change in EBIT. So, if I ask you, if I change my sales by 1%, my EBIT is going to change by what percent? That's what we mean by the operating leverage. And the operating leverage formula says as percentage change in EBIT upon percentage change in sales. percentage change in EBIT upon percentage change in sales. So in our case, we can compute this as, so what was the percentage change in EBIT in our example? My EBIT changed by 17.14 times, right? So it is like 17.14%. Upon percentage change in sales is 10%. The percentage change in EBIT is 17.14% and percentage change in sales is 10%. Okay. So now if I tell you by what percentage change it is set to 1.714 is the answer. And this 1.714 is the measure of operating leverage. 1.714 is the measure of operating leverage. And that's going to be denoted as times. That's always going to be denoted as times. Or I can interpret this as, you can say this interpretation as, for 1% change in sales, there will be 1.714% change in EBIT. For 1% change in sales, there will be 1.714% change in EBIT. Now, percentage change in sales, remember this sales was the efforts portion. And what we got in EBIT as a larger number is the result. Right? Same thing, same concept as the lever. Less efforts, more results. So here you put up 1% extra effort, you get 1.714% extra result. So for a very small amount of additional effort, you get great results out of it. And that's the typical thing that we say as a leverage over here. Right? That's a typical leverage that we say. Okay, that's the first portion, which is operating leverage. Now, similar sort of leverage we observe even in the financial terms. Now, first understand, before we go to the financial terms, can you tell me why is there this leverage of 1.714? Can you identify what is the reason that causes a 10% change in sales, 17.14% change in EBIT? What is the reason that the change in EBIT is greater than the change in sales? What could be the reason for that? Can you identify, guys? Can you tell me what could be the reason for that? What is the company really doing that great that, just putting up 10% extra will result in 17% extra result, will result in 17% extra EBIT? Fixed cost is same, exactly. See, your 25,000 is remaining constant. So my revenue changed by 10%. Obviously, my variable cost also changed by 10%. My contribution also changed by 10%, but my fixed cost didn't increase. Sir. It means I'm having all the benefits increasing to me at 10% rate, but one portion of the cost, which is the fixed cost, that is not changing. That's remaining constant. So one portion of the cost is remaining constant, and that's the reason that since the fixed cost is remaining constant, our EBIT performs at a better pace, or I can say EBIT increases at a better percentage as compared to the sales and the contribution. Okay. Now, similar sort of fixed cost, there is one more which is called as an interest. Right? This fixed cost was triggering the operating leverage. Fixed cost was triggering the operating leverage. Interest is going to trigger the financial leverage. Fixed cost was triggering the operating leverage. Interest is going to trigger the financial leverage. Now, financial leverage, if you look at the definition, it says, by what percentage will the profit after tax change? Or you can say by what percentage the PAT, by what percentage is the PAT or EPS will change for 1% change in the EBIT. By what percentage will the PAT or EPS change for 1% change in the EBIT. So over here, the efforts stand for EBIT, because when we are looking at finance part, it has to be only beginning from EBIT, because till EBIT everything is operating. So beyond EBIT we have to talk of efforts. So EBIT is the efforts, and the resultant figure is the PAT or EPS. And if you look at the formula for financial leverage, it says percentage change in PAT upon percentage change in EBIT. Financial leverage is percentage change in PAT upon percentage change in EBIT. Now, when we talk of percentage change in PAT, what's the change in the percentage, or what, for how much percent is my PAT or EPS changing? So it's all same, 30%. You can say this is 30% upon what is the percentage change in the EBIT? In EBIT, there was a 17.14% change, and therefore you can divide it and you'll get this answer as 1.75 times. 1.75 times. Now, what does this 1.75 times means? This simply means for 1% change in, for 1% change in EBIT, there will be 1.75% change in PAT or EPS. The 1% change in EBIT is actually the change in the effort, and 1%, 1.75% change in PAT or EPS is the result. So for 1% change in EBIT, what will be the change in PAT or EPS, or the result? Next, that's the 1.75 times. This indicates the financial leverage, wherein we assume the EBIT to be the effort and the resultant is PAT or EPS. Okay. Coming to the next leverage, which is a combined leverage. So that combined leverage means by what percentage will the PAT change for 1% change in sales. So now we are connecting the sales with the EPS level or with the PAT level. You see, change in sales was 10%, resultant change in EPS was 30%. So you put 1% extra effort over here, you get 3% result in the form of combined result on the entity. So if you look at this formula, there's actually change in PAT is 30% upon change in sales is 10%. That is actually 3 times. So this 3 times means for 1% change in, for 1% change in sales, there will be 3% change in, for 1% change in sales, there will be 3% change in PAT or EPS. For 1% change in sales, there will be 3% change in PAT or EPS. Right? So over here, we take the entire chain, that is for 1% change in effort, there is going to be 3% change in the result. Right? And you can identify one simple arithmetic rule. That's a operating leverage multiplied by financial leverage gives you the combined leverage. Perfect. Correct. We can state over here, sir, resultant impact of all of them together. Combined leverage, our combined leverage is going to be operating leverage into financial leverage. You can say it is 1.714 into 1.75. That should be resulting to 3. Okay, so 1.714 into 1.75 should result into 3. And that's the formula for combined leverage also. The combined leverage, we can say it's operating leverage multiplied by the financial leverage. Okay, so we can say the fixed cost is triggering the operating leverage. Interest is triggering the financial leverage, and both of them together, fixed cost as well as interest, both of them together are triggering the the combined leverage. Fixed cost triggers operating leverage, interest triggers financial leverage, both of them together are triggering the combined leverage. Okay. Now, so do we need to, every time whenever I want to know the operating leverage, do we need to always prepare a table like this and do it, or there exists some shortcut? There exists a shortcut, right? So let's look at first the shortcut. So shortcut formula for leverage. Let me just prove a shortcut formula for leverage. The operating leverage stands as percentage change in EBIT upon percentage change in sales. Okay. We can say over here, so percentage change in EBIT upon percentage change in EBIT upon percentage change in contribution. We have observed from the table itself, guys, that whatever is the percentage change in sales, that itself is a percentage change in the contribution. Right? Earlier it was 60,000, then it became 66,000. We find that percentage change in sales is same as the percentage change in contribution. So we can very well say it in that sense. Right? So this is from the table itself. Every time it's going to be the same. Okay. Now if I ask you, how do we get the percentage change in EBIT? You will say, sir, EBIT new minus EBIT old, EBIT new minus EBIT old upon EBIT old, the whole divided by percentage change in contribution. Now percentage change in contribution is contribution new minus contribution old upon contribution old, right? Obviously, since it's percentage change, you will also multiply this by 100, but these 100 will get cancelled. And then we can rearrange the same terms as EBIT new minus EBIT old upon EBIT old multiplied by contribution old upon contribution new minus contribution old. Okay, we just rearrange these terms. And on rearrangement, just observe that EBIT new minus EBIT old. If you look at the figure, the EBIT new minus EBIT old. See, 35,000 has become 41,000. So the difference is 60,000. Then contribution new minus contribution old, still you find it to be 6,000. 6,000, 6,000. It's the one and the same, right? So I can say that EBIT new minus old is 6,000 Contribution new minus old is still 6,000. And what we do is we can cancel out these terms together. And what we are left out is the old contribution upon old EBIT will give you the operating leverage formula, or operating leverage times as whatever contribution that you have been given divided by the EBIT level, that will make it the operating leverage figure. Similarly, the shortcut for financial leverage, you can derive it in this same way: EBIT upon profit before tax, and the shortcut for combined leverage is contribution upon profit before tax. So that's operating leverage into financial leverage is the combined leverage. Okay, I hope this shortcut formula you're able to digest it easily. I haven't given it in front of you as it is. I have just derived it for you. Are we good with this formula, guys? Operating leverage, financial leverage, and the combined leverage. Yep, guys. Are we good with the formula? Everyone understood this shortcut formula? And henceforth, anyways, we are going to use this shortcut formula only for calculating the leverages. Yep. We good with this formula? Yes, everyone? Perfect. Now, my question to you is leverage good? Is leverage good? Is leverage really good, guys? To understand whether leverage is really good or not, let's do one thing. Coming back to this table, I want you to work out now the income statement. If my sales unit get reduced by 10%, try to have the income statement when the sales unit get reduced by 10%. Yep. So for the same company, suppose 10,000 units are getting reduced by 10%. What will be the resultant impact? The resultant impact will be units will be 9,000 units. Sales is going to be now 90,000 because 10 rupees is the sale price. Variable cost is 4 rupee. So 4 into 9,000 is 36,000. Contribution will become 54,000. Fixed cost is 25,000. Will remain as it is. Then EBIT will become 29,000. Interest is 15,000. And profit before tax is 14,000. Tax is at the rate of 30%, which should be 4,200. And profit after tax will become 9,800. Dividing it by the number of shares, we observe that EPS is 9.8. So let's try to understand what is happening with the numbers. What we observe is contribution has reduced by 6,000. That translates to 10% change. Similarly, EBIT has also reduced by 6,000. But guys, this 6,000 is translating to a percentage change of 17.14%. And same way, you can observe that PAT as well as the EPS, they are also getting reduced by 30% respectively. 30% respective. Okay. Right. So 30% change. So now my question to you stands as, is leverage good? Looking at these numbers, you observe that if you're putting your efforts lesser by 10%, or if you reduce your effort by 10%, results are also going to reduce at a greater percentage. Is it good or not? Sir, it depends. It depends, right? It depends. Sir, it depends on what? It depends on the level of sales. So if your answer is leverage good, you have to give like, sir, yes, it is good. Sometimes it may not be not good also. It is good if sales are increasing, and if it's not good if your sales are decreasing. Okay. So leverage, be it operating or financial, ultimately what boils down is from the sales. If you have good sales figure, you will have good EBIT, you will have good profit before tax and profit after tax figures. Right. So if you want to make the most out of the leverage, you need to focus on increasing the sales. Correct, guys? So the answer is leverage good? Yes, sir, it's good if the sales is increasing. It's not good if the sales is not increasing. Okay. So that's the very first part of leverage that I wanted to discuss. Now we will do some sort of questions to answer these leverages. Okay, to solve it solves a variety of questions for understanding these leverages. Okay, are we good till now? Everything is crystal clear, whatever we have done till now. Yep, very good. Yep, fine. So leverage, as we say, it's a measure of, when you say that it's good as well as it's bad, it means it's a measure of risk. Your operating leverage is a measure of operating risk of the business. Is a measure of operating risk. Higher the number, higher is the risk. Lower the number, lower is the operating risk. Financial leverage is a measure of financial risk. Financially, how much risk you have undertaken, right? And this is a measure of overall risk. This is a measure of overall risk of the entity. Okay. Let's look at some queries. If there are any, denominator, what was the denominator? Denominator of financial leverage is profit before tax. We have this profit before tax, same as over here. We changed the, remember, we changed from percentage change in sales to percentage change in contribution. Same way, whatever is the percentage change in PAT, that is the same percentage change in PBT, that is the same percentage change in PAT, and even in the EPS. So therefore, we take it as a PBT. So leverage is not concerned with only debt component. Raghavan, no. When you say leverage in capital structure, it is only the debt component. But when we say leverage in general sense, it means the risk. And the risk comes from the operating as well as finance, from both perspectives. Are we good till now? Everyone? Fine. So let's go ahead and start solving uh, a typical question from now onwards. We'll have the questions to be solved from the next moment onwards. So we'll have this question. I have already uploaded this question file on the portal in which we have roughly around 10 questions. Let's go ahead with the question number one. Let's go ahead with question number one. Question one. Find out the operating leverage from the following data. We have sales of we have a sales of 50,000. Uh, Variable cost is 60%. Fixed cost is 12,000. Compute the financial leverage from the following information. Net worth is 25,000. That's the second part. That's the second part of question. The first part we have to focus is on the operating leverage. So let's prepare the small income statement in which we start with sales. Start with sales figure. And the sales figure is 50,000. Then we have the variable cost. Variable cost is at the rate of 60%. That's like 30,000. Okay. And that gives us 20,000 as the contribution. Sales of 50,000 less variable cost of 30,000. Contribution is 20,000. From that, we subtract the fixed cost that is given to us as 12,000, and then we have the EBIT as 8,000. Okay. Then we talk of operating leverage. Operating leverage is contribution upon EBIT. Operating leverage stands as contribution upon EBIT. Contribution is 20,000 upon EBIT of 8,000. Right? So that's what we can get it easily as $2.5 times. Right? That's pretty simple. Now coming to the second part of the question, we have to compute the financial leverage. So in the second part, we have been given the net worth. Financial leverage, we have been given a net worth of 25 lakh, debt equity ratio is 3:1, interest rate is 12%, operating profit is 20 lakh. And we want the financial leverage. So how do we get the financial leverage? So let's understand first with the operating leverage component. The operating leverage, or I can say, sorry, operating profit component. So when we mean by operating profit, we talk of EBIT. So earnings before interest and taxes, 20 lakh. operating profit is operating profit or EBIT stands as 20 lakh. From that 20 lakh, we need to subtract the interest. Now, interest rate is given 12%, but sir, we don't know what is the amount of debt, right? So we don't know what's the amount of debt. So let's first compute the amount of debt by using this debt equity formula, by saying that debt upon equity, debt upon equity is 3 upon 1. Now, net worth itself is the equity shareholders fund. We have net worth as 25 lakh, and therefore we get the debt value. Debt value as 75 lakh. Debt is 75 lakh, right? Debt amount is 75 lakh. Now on this debt, we are going to pay an interest at the rate of 12%. Interest at the rate of 12% of 75 lakh, right? So interest works out to be 9 lakh. We get a profit before tax of 11 lakh. We have got PBT. Now talking of the financial leverage, the financial leverage is EBIT upon profit before tax. That translates to 20 lakh divided by 11 lakh, which is 1.8182 times. Always remember it to be measured in times. Okay. The first question clear to you guys? The first question clear to everyone? Yeah. Nice. Fine, yes. Then we can go for the next question, which is obviously the second question. Let's look at this question number 2 now. Question number 2. The following details of RST Limited for the year ended 31st March 2006 are given below. Yeah. Operating leverage of 1.4, combined leverage of 2.8. Fixed cost, excluding interest, is 2.04 lakhs. Sales is 30 lakhs. 12% debentures of rupees 100 each. Equity share capital of rupees 10 each. Rupees 17 lakhs. That's basically over here. 17 lakhs. Income tax rate is 30%. We are required to calculate the financial leverage, calculate the PB ratio and EPS. The company belongs to an industry whose assets turnover is 1.5 times. Does it have a high or low asset leverage? At what level of sales the EBT of the company will equal to 0? Okay, so we'll solve this thing one by one. First and foremost that we need to do over here is we have information about operating leverage. Operating leverage in the question. Operating leverage in the question is 1.4, and combined leverage is 2.8. Combined leverage is 2.8. And the question first asks us to calculate the financial leverage. It's very simple, right? Because we know combined leverage is operating leverage into financial leverage. Combined leverage is 2.8 equal to operating leverage of 1.4 into financial leverage. The financial leverage will be 2 times. Simple calculation. Now it asks us to compute even the PV ratio and the earnings per share. Now to compute the PV ratio and earnings per share, obviously we need to first prepare the income statement. So let's prepare the income statement for this company. Income statement starting with sales. Sales, is it stated in the question? The figure of sales? Yes, sir. Sales is stated as 30 lakhs. Okay, great. We have sales of 30 lakh. From that, we need to deduct the variable costs so that we get from that contribution. And then from contribution, we deduct the fixed cost on which we get EBIT less interest fixed cost, EBIT, interest. Then we have profit before tax less tax figure. We had a profit after tax divided by number of equity shares should give us the EPS figure. Now, how do we get the variable cost? How do we get the variable cost? We just have a fixed cost figure available, which is excluding interest of 2.04 lakhs. So let's write down the fixed cost figure, 2 lakh 4,000. 2 lakh 4,000. Then we need to have the interest components. Our interest can also be obtained as simply 12% of 21.25 lakhs. Right. So interest is 12% into 21.25. %12 of 21.25 lakhs should give you number as interest as 2 lakh 55,000. Number of equity shares is 1 lakh 70,000. This is what we have in the question. I need to compute rest all things, right? I need to compute the other things. Now, how do we go about the other thing calculation? The only way by which we can solve this is to take help of the operating leverage and the financial and the combined leverage. So let's say operating leverage is 1.4. So operating leverage of 1.4 is computed as contribution upon EBIT. Now, of course, this contribution upon EBIT we can get it as contribution minus the fixed cost. So 1.4 is the operating leverage, and you can get the EBIT as contribution minus fixed cost, which means 1.4 is, we don't know contribution, but we know the fixed cost. So it's contribution upon contribution minus fixed cost of 2,04,000. Therefore, if you multiply it, you get it as 1.4 contribution minus 1.4 into 2,04,000, which should be 2,85,600 equal to contribution. And therefore 0.4 contribution is 2,85,600. The contribution will be 2,85,600 divided by 0.4. So we get the figure of contribution by dividing this as 7,14,000. 7,14,000, yeah. We can write out contribution as 7,14,000. So once I get this contribution at 7,14,000, all other values above it and below it will be computed very easy. If the contribution is 7,14,000, variable cost is going to be how much? Variable cost is going to be 30 lakh minus 7.14 lakhs, which is obviously 22 lakh 86,000. 7,14,000 minus fixed cost of 2,04,000. EBIT stands as 5,10,000. So interest subtracted 2,55,000. PBT will be also 2,55,000. Tax, the rate of tax given in the question is 30%. So 30% of 2,55,000 going to make it as 76,500. Profit after tax figure is 1,78,500. From that you divide it by number of equity shares, which will make it as 1.05. Make it as 1.05. Yeah. So this entire statement is ready. As per this statement, we have got the EPS figure. We need the PV ratio now. What will be the PV ratio over here? We know PV ratio. PVR, I'm not talking of the theater PVR, I'm talking of PV ratio. Okay. PV ratio. PV ratio is basically contribution as a percentage of sales. Contribution as a percentage of sales, which is 7,14,000 divided by 30 lakh sales. That's 23.8%. 23.8% is the PV ratio. Let me look at the query. Anything is there? Gayatri Pandava is asking, sir, in question 1, EBIT in case of operating leverage is what we have calculated, and EBIT in case of financial leverage is what is given in the question. Why we have done like that? These are two separate questions. Gayatri, these are two separate questions. The first part was part A of the question, second part was part B. Both of them are separate. Okay, therefore that's the different thing. Yeah. By the way, what's the full form of PV, by the way, guys? What's the full form of PV? PV ratio, full form of PV. I want it from your end. What is full form of PV? Tell me. What is the full form of PV? One. Profit volume ratio, correct. That's a profit volume ratio. I think you might have learned this in uh, cost accounting in the marginal costing chapter, right? Profit volume ratio, it indicates, or it's a number which states of your sales figure, what percentage is your contribution? What percentage is the contribution? Or I can say, after subtracting all your variable cost, how much is still left in your hand? So from 100, if you say over your PVR is 23.8, it means 23.8% is the contribution. Out of 100, you can say 76.2 is the variable cost. And the balance is left out, that is used for paying the fixed cost and the other interest and outflow, right? Fine. So we have done the first part and the second part. Now coming to the third part of the question. Third part of the question says, if the company belongs to an industry whose asset turnover is 1.5 times, the asset turnover is 1.5 times, does it have a high or low assets leverage? So first we need to compute over here asset turnover for this company. Asset turnover. Asset turnover is computed as sales upon assets. So do we have the sales figure? Yes, sir, 30 lakh. How much is the total assets that we have? Now, of course, sir, assets has to be equal to liabilities. Now, when I say it is equal to liabilities, that's actually equal to equity plus debt, which is obviously equity of 25 lakh and 75 lakh debt, right? So this comes out to be 30 lakh upon 100 lakh, which is 0.3 times. Now, what does this 0.3 time mean? In industry, the asset turnover in the industry, the asset turnover is 1.5. It means rupees 1 asset leads to rupees 1.5 sales. In the given case, in case of the given company, it is 0.3. Now, what does that 0.3 mean? 0.3 means 0.3 asset, or I can say rupees 1 asset leads to rupees 0.3 sales. So now, is the company really doing good in terms of asset turnover? Is the company doing good in terms of asset turnover? In the industry, the other companies are putting 1 rupee asset and they are able to generate 1.5 sales. Our company is putting 1 rupee asset and it is able to generate just 0.3 rupees sale. Right? Equity is 17 lakh. Where is it? Mansha, that's equity share capital. Equity share capital was 17 lakhs, right? But then, if you look at this figure over here, equity share capital of 17 lakh, and then we have 12% debentures of 21.25 lakhs, correct? And then interest cost, debentures of 21.25 lakhs. Okay, did I just mix it up? Yeah, correct, guys. I just mixed it up. My bad. My bad, guys. So equity and debt is, yep, correct. So equity is 17 lakh and debt is 21.25 lakhs. This translates to 17 plus 21.25, 38.25 lakhs. That's 30 divided by 38.25 lakhs, which is 0.78 times. It is 0.78. Yeah, correct. 2575 was in the last question, correct? So industry asset turnover is 1.5 and our given company asset turnover is 0.78. So in industry they put up 1 rupee asset and they're able to generate 1.5 sale, and this company putting 1 rupee asset and they're able to generate only 78 paise of flow of the asset of the sales. Is it really doing good? Is it doing good as compared to the industry? Is this company doing good as compared to the industry? Of course not, sir. Industry, we are not at par with the industry. We are performing lower than the industry. So we can say low asset turnover. We have a low asset turnover as compared to industry. As compared to industry, we are having a low asset turnover. Okay. Then the next part of the question says, at what level of sales EBT of the company will equal to zero? At what level of sales EBT of the company will be equal to zero? Okay, so we need to look till EBT or earnings before interest and tax. So I'll just copy this much portion for our understanding. Okay, we have sales 30 and all these figures are there. Now the question says that if you want this profit before tax figure to be zero, how much should be the sales? So we can do a backward calculation, right? Remember, if you want the PBT to be zero, understand that you need to earn or you need to pay the interest, right? So you need to pay 2,55,000 as the interest. You also have to pay 2,04,000 as the fixed cost, because you cannot run away from these costs. You have to bear it. So now if you want the PBT to be zero, interest is what you need to earn. Interest is what you need to earn. So what will be the earnings before interest and tax? Earnings before interest and tax. It should be 2,55,000. Earnings before interest and tax should be same, 2,50,000, 2,55,000. So that whatever you have EBIT, that is what you pay as interest, and you are left with PBT as zero. If this is supposed to be 2,55,000, fixed cost is 2,04,000. What about the contribution? How much should the contribution be? Of course, with the reverse calculation, you can say that it is 2,50,000, not 2 lakh, 4,59,000. We simply did a reverse calculation of 4,59,000. Now, since the variable cost, if you look at this figures, sales was 100, so our contribution or the PV ratio that we had was 23.8. For every 100 rupee sale, we have a PV of 23.8, or we have a contribution as 23.8. Contribution is 23.8. For every 100 rupee sale, we have a contribution of 23.8. Then we can have this cross multiplication and we can get this sales figure. So on cross multiplying and then the sales figure, we can say that this comes out to be 19,28,571. Right? This is similar to somewhat you might have computed in your costing break-even point. Break-even point is what you might have learned as fixed cost upon PV ratio. Now over here, fixed cost will be 2,04,000 plus 2,55,000. You divide it by PV of 23.8%. Ideally, you should be getting the same 19 lakh 28,000. 2 lakh 4,000 plus 2 lakh 55,000, dividing it by 23.8%, give you the same 19 lakh 28 by 71. Right? That's a break even point. That's the point at which you are earning no profit, no loss. Yeah. So break even point works out to be 19 lakh 28,571. This question number two. With that, we are done with question two. All the numbers are done. We have calculated the financial leverage. We are done with the PV ratio and EPS. Asset turnover is also discussed. EBT of the company will equal, that's also discussed, right? So this question is done. Are we good with this question two, guys? Are we good with this question number two? All clear? Everyone? If PBT becomes zero, how can we pay tax? You need not pay tax. If PBT is zero, actually then no tax is to be paid. Zero tax. Okay, fine, guys. So with that, will question two is clear. Okay, why we had 2,55,000? Because Hiral, 2,55,000 is also my fixed cost, right? It's an interest payment. That's also a fixed cost. Fixed cost 2,44,000 was the operating fixed cost. This is the financial fixed cost. And when we want to get the break-even point, overall sales that we need to have, fixed cost will include all types of fixed cost, operating as well as financial. Right? So let's take a break now of 10 minutes, guys. After that, we'll do some more questions. Let's take a break now, guys. Welcome back, guys. We have done question number 2 right now. Let's take up the next question, which is question number 3 now. Yeah, question 3. Question 3. Here we have from the following: prepare income statement of company XYZ. Briefly comment on each company's performance. Company XYZ, just the name is differing. Okay, typo error. X, Y, and Z. We have the financial leverage number, interest is given, operating leverage is given, variable cost as a percentage of sales is given, income tax rate is given as 45%. So you have to prepare the income statement of all the three companies and then go for the comment portion of it, right? So I'll do for company A, company B and C, or company X, Y, Y and Z, as you say. Let me change it over here. It's A, B, and C. So I'll do it for A. For B and C, you can take that as a homework and you can try it at home. Okay. So let's do this question number 3. From the following, prepare income statement of company A, B, and C. So we need for company A first. For company A. Let me draft the income statement first, starting with sales. Sales less variable cost will give us the contribution. From that, when we subtract the fixed cost, we get EBIT. From EBIT, we get reduce the interest, get profit before tax. From that, we subtract the tax, and what we get is profit after tax. Now, sales, we have not been given anything. What we know is that only the interest portion is known to us, which is 200. So let's write down the figures. Interest is 200. Okay. Rest all, nothing is given. So the only way to start this question, solving this full thing, is using this interest. Now we know which type of leverage is triggered by interest. So it's financial leverage. So we'll take help of this financial leverage term to do the calculations. We have the financial leverage as 3:1. Since financial leverage is 3, therefore, we know financial leverage is given by the formula as earnings before interest and tax upon profit before tax. So EBIT upon PBT is 3. Therefore, we have this EBIT upon PBT is EBIT minus interest is 3. So let me take EBIT as just E instead of writing it again and again. I can just write it as E. E upon E minus interest is 200. Okay. That's equal to 3. Therefore, E is equal to 3E minus 600. That will be minus 2E equal to 600. Simple arithmetic calculations. And we say that earnings is or EBIT stands as 300, right? Earnings before interest and taxes 300. We get this EBIT as 300, correct? Now, once I get EBIT, I can flow down and state that my profit before tax will be 100. Profit before tax will be 100. Tax rate is given, I suppose. Income tax rate is 45%. The tax will be 45. Profit after tax will be 55. Now to go up from EBIT onwards, from EBIT till sales figure, we'll have to take help of operating leverage. Since the operating leverage is 4, we can say as per the formula, operating leverage is what? Contribution upon EBIT is 4. Therefore, contribution upon, we know EBIT is 300. That's equal to 4. And therefore, can get the contribution as 1200. The contribution is 1200. Can you tell me what will be the fixed cost? Of course, it's the balancing figure, sir. So you can say fixed cost is the balancing figure of 900, right? Now to compute sales and the variable cost, we have to take help of this number. Variable cost as a percentage of sales. Variable cost as a percentage of sales is 66, 2 by 3%. So we can say if sales is 100, variable cost is 66, 2 by 3%, or 66, 2 by 3. And contribution will work out to be 33, 1 by 3. Or to talk in other sense, we can also state this as this is 1, this is 2/3, and contribution is 1/3. Okay. Okay. We get this by doing a cross multiplication. By simply doing a cross multiplication, you can get the answer easily. By doing cross multiplication, since this is 1/3 sales, if it is one time, then this means it is equal to 3,600. And since the other it is 2/3, that will be 2,000, 3,600, 1,400, and 1,200 will be the sales variable cost and contribution figure. Okay, that's how we prepare the income statement for company A. Can you take this for company B and C as homework? Similarly, can you solve company B and C figures? Yes, guys. Can you solve for company B and C similarly? Solve it, guys, for company B and C. Yep. Yes. Sure. Great. So in that case, let's go ahead with the next question, which is question number 4. Question number 4. The operating income of a textile firm amounts to 1,86,000. Operating income of a textile firm amounts to 1,86,000. It pays 50% tax on its income. Its capital structure consists of the following. So it has 14% debentures of 5 lakh, 15% preference shares of 1 lakh, equity shares of 4 lakh. We want to know what will be the firm's earnings per share. We want to know the percentage change in EPS associated with 30% change, both increase and decrease in EBIT. Okay. So determine the firm's EPS, determine the percentage change in EPS associated with 30% change, both increase and decrease in EBIT. Fine. Determine the degree of financial leverage and current level of EBIT. What additional data do you need to compute operating as well as combined leverage? Okay. So the question says there is an operating income of 1,86,000. What do you mean by this operating income of 1,86,000? So 1,86,000 operating income simply means we are talking of the EBIT component, right? So let's begin with it. Question number 4. EBIT. Operating income, or as you say it as earnings before interest and tax, EBIT. The EBIT of 1,86,000. EBIT of 1,86,000. From that, we reduce the interest. That interest is 5 lakh is the interest, 5 lakh is the amount, and 15% is the debenture. So we will be paying for 14% is the rate of interest. The interest will be 5 lakh multiplied by 14%. 5 lakh multiplied by 14%, which will be 70,000, in which we get profit before tax. Profit before tax is 1,16,000. From profit before tax, we reduce the tax figure, which is stated as tax rate is 50%. 50% means tax amount is 58,000. From that, or we can say we get that as profit after tax. From that, we are going to deduce the preference dividend. Right? So PAT is 58,000. Preference dividend is 15,000. We get net profit for equity shareholders. Net profit for equity shareholders is 43,000. And then this divided by a number of equity shares. Number of equity shares is basically 4,000. And we get the earnings per share as 10.75. This is the existing income statement. We get the firm's EPS as 10.75. Then they say determine the percentage change in EPS associated with 30% change, that is increase or decrease in EBIT. So if the EBIT changes by 30%, what will be the percentage change in EPS? Can you tell me which leverage are we going to use? Which leverage are we going to use? If I want to see what will be the change in EPS due to change in EBIT, which leverage am I going to use? Is it operating leverage, financial leverage, or combined leverage? Which leverage am I going to use? I want to know by what percentage my EPS will change due to some change in EBIT, which leverage am I going to use? Is it operating, financial, or combined? Combined. How will you use combined leverage? Combined leverage is always connecting your sales with your EPS. Here we are just connecting what? We are connecting the EBIT with EPS. So whatever is the leverage, that will be only due to this interest. So definitely we are going to use financial leverage. So first I need to compute over here the financial leverage figure. Financial leverage. Financial leverage is EBIT upon PBT. Can I use this formula? Financial leverage, EBIT upon PBT. Can I use this formula? You can't use this formula, guys. You cannot use this formula because in this case we have preference dividend available with us, right? I cannot compute the financial leverage by just considering EBIT and PBT because there is a case of preference dividend in this case. There's a case of preference dividend. So now, when we have preference dividend, how can we compute the financial leverage? When we have preference dividend, how can we compute the financial leverage? Okay. Yep. So let's look at how do we compute that. Before we go into that formula, I will definitely try to do it in the other way around. Other way around in a sense that suppose uh, we increase, suppose we increase this EBIT by 30%. Increase this EBIT by 30%. Right? So this will become plus 30% means it will become 2,41,800. Okay. Interest will definitely remain constant at 70,000 itself. PBT will become 1,71,800. Tax that we need to pay is 50% of this. So it means 85,900. And PAT is also 85,900. Preference dividend is 15,000. Net profit for equity shareholders is 70,900. And number of equity shares is 4,000. And your EPS will work out to be 17.725. This is for 30% increase. Same way, you need to do it for 30% decrease also. When the EBIT decreases by 30%, it will become 1,30,200. Interest will remain same, 70,000. Profit before tax is going to be 60,200. And then the tax rate is 50%, so that's 30,100. PAT will be also 30,100. Preference dividend will be 15,000 remaining constant, and net profit for equity shareholders will be 15,100. Number of equity shares is 4,000. We get an EPS of 3.77. EPS of 3.775. Okay. So we get this numbers. Now, if you look at So what is the percentage change? You'll find that this has increased by 17.725 minus 10.75 divided by 10.75. That will give you 64.88%. And from here till here, you'll have it as 3.775 minus 10.75 divided by 10.75. There's a reduction of 64.88%. We have actually answered this question. Determine the percentage in EPS associated with 30% change, both increase and decrease in EBIT. We increase the EBIT by 30%. We also decrease the EBIT by 30%. We increase the EBIT by 30%. We decrease the EBIT by 30%. And what we observe is that EPS is changing by 64.88%. Okay. Okay, so financial leverage needs to be computed over here now. Financial leverage. Financial leverage will be, as we know, the original formula, not the shortcut one. I'm talking about the original formula. Original formula was percentage change in EPS upon percentage change in EBIT. Financial leverage stands as percentage change in EPS upon percentage change in EBIT. Now, percentage change in EPS, we know it is 64.88. Percentage change in EBIT was 30. So, financial leverage will work out to be 2.16 times by the original formula. Now, the question arises, sir, just as we had a shortcut formula for operating leverage as or financial leverage as EBIT upon PBT. Right? We had a shortcut formula of earnings before interest and tax upon profit before tax or earnings before tax. Right? Same way, do we have a shortcut formula for this type of financial leverage also when we have preference dividend? Do we have any shortcut formula? Yes, we do have a shortcut formula for this, and that shortcut formula is EBIT. I'm not going to derive this because you won't be able to understand the derivation. Anyways, in exams, derivations are not required. You need to know the formula. So the financial leverage when preference dividend is applicable, it is EBIT upon profit before tax minus preference dividend upon 1 minus tax. So EBIT, original EBIT is 1,86,000 upon profit before tax. We had 1,16,000. From that, I reduced the preference dividend of 15,000 upon 1 minus 0.5. Is 1,86,000 upon 116,000 minus 30,000. 1,86,000 divided by 86,000. Yeah. Divided by 86,000. So that will work out to be 2.16 times. You can see, you can use this either of the formula, right? Yeah. Prabhas is asking, sir, can it be a case that the change in EPS will not match? Prabhas, it will definitely match. If you're changing EBIT by 30%, that is Once you are increasing it by 30% and then you're decreasing it by 30%, in both the cases, the percentage change is going to be same. It will definitely match. It will never be a case that it's not matching. Okay. So remember this shortcut formula for financial leverage. Remember this shortcut formula for financial leverage, guys. Are you good with it? Question 4, guys. Is the question 4 clear? Have we computed everything? Firm's EPS is done. EPS as 30%, it's done. Determine the degree of financial leverage, that is also done. What additional data do you need to compute operating as well as combined leverage? Tell me, guys, what extra information do we need to compute the operating leverage? What information do we need so that we are able to compute the operating and financial leverage? What additional information is needed? Yep. Sir, we need contribution. Either the question should provide us information of contribution or fixed costs for computing operating leverage. We need the information about the contribution or fixed cost for computing the operating leverage. Right? Now let me look at the queries. If there are any. Hiral is asking, can we use EBT and PBT? Yes, Hiral, you can. Why we take preference dividend in financial leverage calculation? Hiral, because preference dividend is again a type of fixed obligation upon you, which you need to pay. Preference dividend is type of fixed obligation, and therefore you need to pay for it. You need to consider that as a part of your financial leverage. This chapter important from practical perspective or theoretical? Mostly practical, because we'll have practical questions over here. But yes, some sort of analytical will be there. Like we may ask you, 2.16 times explain the implication of this, or you need to understand that higher leverage means higher risk, right? So that sort of risk interpretation also is required from this chapter. Okay, guys, are we good? Shall we go for some more questions? Some more questions. Shall we proceed with some more questions, guys? Yep. Yes. Okay, great. Let's go for now question 5. I am giving it as homework. You can try it at home. I'll upload the solutions on the portal. Question 6 is what we are going to look at now. Question 6. X Limited has estimated that for a new product, X Limited has estimated that for a new product, the break-even point is 20,000 units. If the item is sold for rupees 14 per unit and variable cost is 9 per unit, calculate the degree of operating leverage for sales volume 25,000 units and 30,000 units. It estimates that for a new product, break-even point is 20,000 units. One item is sold for 14 rupee per unit and 9 rupees the variable cost. So we have sale price per unit. Sale price per unit is rupees 14. Variable cost per unit is rupees 9. Therefore, we get contribution as sale price minus variable cost, which is 14 minus 9. That comes out to rupees 5. Right? Contribution, of course, this is contribution per unit. Now, they have given that break-even point is 20,000. So we know break-even point is given by the formula fixed cost upon contribution per unit. Break-even point is given as 20,000 units is equal to fixed cost. Fixed cost we don't know. Upon contribution per unit is 5. Therefore, fixed cost is 1 lakh. Fixed cost stands as 1 lakh. Okay. Once we have this fixed cost figure, we need to calculate the degree of operating leverage for sales volume 25,000 units and 30,000 units. So units, let's say in first case it's 25,000. In second case it's 30,000. We have sales figure as since it is 14 per unit, sales will be 14 into 25,000, which is 3 lakh 50,000. And in case of 30,000 units, it will be 4 lakh 20,000 units. Less variable cost. Variable cost is the 9 rupee per unit. So since it is 9 rupee per unit, it will be 2 lakh 25,000 in the first case, and in the second case, it will be 2 lakh 70,000. Contribution will work out to be 1 lakh 25,000, and this is 1 lakh 50,000. From this, we will reduce the fixed cost of 1 lakh, which is going to be a constant figure in both the cases, right? Going to be a constant figure. This EBIT will work out to be 25,000 and 50,000. So operating leverage will be 1 lakh 25,000 divided by 25,000 is of course 5 times. That's like contribution divided by EBIT. And then it is 1 lakh 50,000 upon 50,000, which is 3 times. Okay. Now, an important interpretation lies over here, guys. An important interpretation lies over here. When your sales was 3 lakh 50,000, or when you were selling 25,000 units, your operating leverage calculated to be 5 times. Whereas when your sales are 30,000 units, your operating leverage works out to be 3 times. In the first case, it is 5 times. In the second case, this is 3 times. Okay. These numbers, when your units is 25,000 units 5 times and this is 30,000 3 times, you need to understand that when the units increases, when the number of units increases, the operating leverage figure reduces. Because what is triggering this operating leverage? So this fixed cost of 1 lakh is triggering the operating leverage. Fixed cost of 1 lakh is triggering the operating leverage. Now, when you are reaching a higher level of sales, your capability, it will be more to absorb the fixed cost. When you were having sales of 25,000 units, you are facing a greater risk as compared to the risk that you face when you're selling 30,000 units. If you would be selling like 20,000 units, your level of risk will be also higher. And obviously, simultaneously, your operating leverage number is also going to be higher. So, as the number of units that you sell, the level of sales increases, the risk that you take gets reduced. And therefore, operating leverage will also get reduced. Okay. So, one important highlight that we need to put up over here is operating leverage will reduce as the level of sales increases. Yep. So operating leverage is going to reduce as the level of sales increases. As the level of sales increases, operating leverage is going to fall. Okay, because the risk reduces. When you sell more and more goods, when your sale increases, you are in a better position to undertake a risk. Okay, so that was the important uh, highlight that I wanted to make over here. Right. So if your operating leverage is higher, obviously operating risk is higher. Correct. Hiral, you're right. As the operating leverage is high, the operating risk is higher. Correct. And leverage is the degree of risk. Yes, Rahul, I told it at the very start of our session that operating leverage or financial leverage, or for that matter, combined leverage, all of them are just measures of risk. One or the other way, they try to measure the level of risk. Okay, fine. That was question 6 for you guys. Um, let's take up another interpretative question, and that's going to be question number 7. That's going to be question number 7 now, guys. Yeah. A firm has sales of 75 lakh, variable cost is 56%, fixed cost is 6 lakh, it has a debt of 45 lakh at 9% and equity of 55 lakh. You're required to interpret the firm's return on investment. Does it have a favorable financial leverage? If the firm belongs to an industry whose capital turnover is 3, does it have high or low capital turnover? The operating and financial and combined leverage of a firm. If sales increases by 10%, by what percentage EBIT will increase? At what level of sales EBIT will be, sorry, earnings before tax or PBT, profit before tax will be equal to 0. If EBIT is increased by 20%, by what percentage EBIT will, by what percentage PBT will increase? So, Hiral is asking, is this question include past paper sums also? Yes, Hiral, it does include some of the past paper questions. Uh, Shreya says when the sales increase, then the return will also increase, then the risk should also increase. Yeah, you take it from the other point of view that when you were at 25,000 level, at that time you were having a greater degree of risk. At that time you were having a greater degree of risk. Share the screen again. Okay. Hmm. Yeah. Shrey is asking, as the sales increases, see, you're taking a risk earlier at 25,000, right? At 25,000 units, you undertook a risk and you placed fixed cost. You took the risk, and when the sales increased from 25 to 30,000, you got the return from it in the form of higher EBIT, the form of higher EBIT. So this risk paid off because your sales has increased by some percentage, but then your EBIT will increase by like 50% or almost like 100%, right? So you took a risk over here by undertaking a fixed cost, and that time you said that your operating leverage is 5 times. It means going ahead tomorrow, if my sales increase by just 1%, I'll be able to get a 5% increase in EBIT. That's the interpretation that you need to make there. You're not going to think that if the at a higher level of sales, uh, the risk will be return, or I can say the risk will be lower, the return will be lower. Yes, return will be lower if you go from 30 to 35. From 25 to 30, you will get 5 times additional return. From 30 to 35, you will get 3 times only because you have reached a safer situation. Okay, fine. Let's go ahead with question number 7, in which we have a lot of things to be done, a lot of calculations to be done. So let's prepare first the form as a sales of 75 lakh. We'll start with a sales of 75 lakh. Variable cost is 56%. So less variable cost is going to be 56%. So when we talk of 56%, 75 lakh multiplied by 56%, that should be like 42 lakh as a variable cost. Then you have this contribution, contribution coming up as 33 lakh. From that, you subtract the fixed cost. Fixed cost is given as 6 lakh. We get earnings before interest and tax. Earnings before interest and tax 27 lakh. From that, we subtract the interest. Interest is 45 lakh debt at 9%. So 9% of 45 lakh, which is 4 lakh 5,000. That will give you a profit before tax of 22 lakh 95,000. Okay. So first we need, what is the firm's ROI? ROI is return on investment. ROI stands for return on investment. Okay, so ROI stands for return on investment. So let's compute that first. First one, firm's ROI, return on investment. Return on investment. When you say return on investment, how much is the firm really earning? There's no information about tax rate. So of course, investment of the firm is the total capital employed. And on this total capital employed, you are going to earn EBIT, earnings before interest and tax upon total capital employed into 100. Earnings before interest and tax should be 27 lakh as we have computed upon a total capital employed of 45 lakh plus 55 lakh into 100 is 27 lakh divided by 1 crore. right? So that's like 27%. Now, the question asks us, does it have a favorable financial leverage? Does this problem or does this question has a favorable financial leverage? So for that, return on investment is 27% and rate of interest on debt is 9%. Return on investment is 27%. Rate of interest on debt is 9%. It means we are raising funds at 9% and we are investing at 27%. Tell me, are we having a favorable situation or an unfavorable situation? Do we have a favorable situation over here or do we have an unfavorable situation? Tell me, guys. The given case, do we have a favorable situation or unfavorable situation? Favorable because we are raising funds at a lower cost. We are investing at a higher rate. So, since return on investment is greater than rate of interest, therefore, favorable financial leverage because you are able to bear the fixed cost, right? So, favorable financial leverage. You're able to bear that loan because you're getting the funds at a lower rate and investing it at a higher rate. Okay, guys, that's the second part. Then we have the third one. If the firm belongs to an industry whose capital turnover is 3, does it have a high or low capital turnover? Does it have a high or low capital turnover? See, capital turnover is simply sales upon capital. Sales upon capital. Sales is 75 lakh. What is the capital? Capital we have computed total of 1 crore owned and borrowed, which is 0.75 times. Right. So capital turnover is owned and borrowed. That's 0.75 times. So we can say over here, the other companies are having a capital turnover of 3. So in industry, the capital turnover is 3. What does that capital turnover of 3 means? Capital turnover 3 means for rupee 1 invested, rupees 3 sales generated. In case of given company, it is 0.75. Now, what does that 0.75 means, guys? 0.75 means for 1 rupee invested, rupees 75 sales is generated. Tell me, is it a good thing? The firm belongs to industry capital turnover. Is it having a high capital turnover or low capital turnover? Of course, low capital turnover. Company has low capital turnover. Company has low capital turnover. Right? Then we have to compute the operating, financial, and combined leverage. So operating leverage, we know it is contribution upon EBIT. Contribution was 33 lakh upon an EBIT of 27 lakh. So contribution of 33 lakh upon an EBIT of 27 lakh, which is 1.22 times. Financial leverage is EBIT upon profit before tax. EBIT was 27 lakh. Profit before tax is 22 lakh 95,000, which is 1.1765. Combined leverage is contribution upon profit before tax, which is 33 lakh upon 22 lakh 95,000, which is 1.437 lakh. That's the combined leverage. Yep. Then, if the sales increase at 10%, by what percentage EBIT will change? Percentage change in sales is 10%. So what will be percentage change in EBIT? Percentage change in sales is 10%. The percentage change in EBIT will be how much? Now that will be obviously 10% into combined leverage. Right? Because combined leverage is the connecting point. So that's going to be 10% into 1.22, which is 12.22% change will be there in the EBIT. Okay. Then at what level of sales the EBIT of the firm will equal to 0? At what level of sales will the EBIT or PBT be equal to 0? So we start with sales less variable cost, contribution less fixed cost, EBIT, interest and PBT. So you want PBT to be 0. Of course, interest of 4 lakh 5,000 and a fixed cost of 6 lakh will be fixed for us. You have to do the reverse calculation. And by doing that reverse calculation, sales you will get it as 22 lakh 84,000 and 90, same as previous one of the questions that we have had. Okay. Then finally, the seventh one, if EBIT increases by 20%, by what percentage EBT will increase? So percentage change in EBIT is 20%. What will be percentage change in profit before tax? That will be 20% into percentage change in EBIT is 20%. Percentage change in PBT will be 20% into the financial leverage. That's 20% into financial leverage. We have computed 1.17. 1.1765, which is 23.53%. Right? So that's it with the question number 7. Yep. Oh, my bad. This is 10% into the operating leverage, not the combined leverage. Okay. With that, we are done with the today's session on leverages. I'll be uploading the solution file, this file as well as the other one with the full solution, the portal after today's class. Any other queries that you have, guys, that you need to ask to me? I'll wait for maybe a couple of minutes for your queries. And if there aren't any, then we'll call it a day. Any queries, guys? Clear everything? Shall I have uploaded a solution file of capital structure? Capital structure theory, I think I've uploaded. If it's not showing, I'll upload it again. Any tips No tips, guys. Why do you need a tip? You're not a waiter. So for exams, you need to be like focus on conceptual part. Don't try to mug up anything. It should be conceptually clear. If you are conceptually clear, you will be able to solve any sort of questions. Okay. Yeah. Hiral Parekh, why capital include debt? Capital is the investment in the business. Hiral, don't bring your 11th standard concept here because 11th standard needs to be completed over there itself. Yeah. So in 11th standard, you might have learned that capital is what is brought in by the owner, but over here it's not that case. Here, capital means investment that is made into the business. That money may come from own funds or from borrowed. Borrowed. Total capital is own funds plus borrowed funds. Okay. Question 7.5. Yeah, it was like percentage change in sales was given, and they wanted to know what is the percentage change in EBIT. So we already know that operating leverage is percentage change in EBIT upon percentage change in sales. It was just a rearrangement of this formula and nothing more. Operating leverage concerned with sales EBIT, financial leverage concerned with EBIT, and PAT. What for combined? The one for combined it is sales and PAT. While leverage includes debt component in case of capital structure. In case of capital structure, Shreya, since we are talking of capital, since we are talking of the financing component, only the financial leverage needs to be considered. In question 3, it was 1200. How it is one third of sales. See, sales was variable cost was given as a percentage of sales as 66 2 by 3. When we say 66 2 by 3, it means two-third. Out of 100, 66 2 by 3 is two-third of the total sales. So obviously balance one-third is the contribution. Right? Fine. So with that, uh, learn concepts logically. Thank you. Fine. So we'll stop here for the day. All the best for your exams, guys. Start preparing well and try to learn everything conceptually. Don't mug up things. Because if you learn conceptually, I'm pretty sure you will never forget the concepts and try to answer the questions also into the exam. Okay. So let's stop here, guys. Bye bye. See you.